Hi, welcome to Chapter 14. Today we're going to be talking about annuities and individual retirement accounts. So we have a number of learning objectives to cover in this class. First of which is, what is an annuity? You may be familiar with annuity from your finance class, time value of money, where we talk about the time value of present value annuity and future value annuity. Now these annuities are more of a financial product. So it's a periodic payments that continue for a fixed period of duration that's designed for people to live on as far as retirement mostly. So the annuity can provide protection against loss of pension, loss of income, and also excessive longevity, meaning if you live too long. So this is a protection or protective additional aspect of retirement. Now, the purpose of annuity, for the main point when we talk about insurance annuities, is to provide income that a person can't outlive. So for example, this is where the insurance aspect of annuity comes in. If you have an individual retirement account or 401k, this is a limited amount of money that could run out. So if, say, unexpectedly, they come up with new therapies and new medicines that will extend your life to age 120. Not so far-fetched, considering many people today live into their 90s, and 50, 60 years ago, that was quite uncommon. So life expectancy can take leaps and bounds forward depending on the medical discoveries. So if you had planned a retirement till the age of 95, figuring there was little chance you're living past 95, and you had planned out your retirement for that length, and suddenly you're going to live to a healthy 120, maybe 125, you're going to run out of money. So an annuity will provide income that you can't outlive, and that's sort of the real benefit of annuity. Some of the annuities, the way they're structured, is they'll provide income for as long as you're living. Now, the annuity payments are going to consist of three sources. There's going to be a premium payment, interest earnings, and unliquidated principal of the participants in the annuity who may die early. So figure, when you go into an annuity, you're sort of like in a pool of people, like a pool of people that would be insured. Some people will die early, some people will die younger. So the people who die earlier, their unused principal will help compensate and pay out people who live longer. So that's how these three different sources of annuity payments can continue for a lifetime for some people. Now, actuaries, which are a special job classification, will use this, what they call a mortality table, to calculate annuity premiums, because annuitants tend to be healthier individuals. So the insurance companies that put together these annuities, they do it using a lot of mathematics and statistics to know, okay, this is what we can plan out for certainty to be able to pay out what we promised. And that's really the magic of the annuity, is that you are pulling your money together with a bunch of other people, and you're to be able to cover your lifespan of need. So some people will not use all the money in their annuity, and some people will use more than the money in their annuity. And that's what is going to help people stay in retirement. I guess you could think of Social Security as a giant annuity that covers the American working citizens, where you pay in a certain amount into the Social Security, but you're guaranteed a payout for life. So at your retirement age, or the age you're eligible to claim Social Security, you're going to get that Social Security for the rest of your entire life, whether you live another 10 years or another 50 years. And that's because some of the people who pay into Social Security may die early or never collect, and some people collect a little bit longer. And that's, in a sense, why that Social Security is sort of like an annuity. Okay, so let's talk about the different types of annuities that we have. So an immediate annuity, this is an annuity where you're going to receive your first payment right away. So the periodic payments are going to be a guaranteed amount. It's going to be a fixed amount, say $3,000 a year. And the first payment is going to start typically some sort of interval from your first payment of the annuity, which could be a month or it could be a year. And then you're going to be paid monthly from the start of the first month designated, usually the first month right after you purchase this immediate annuity. Now, the single premium immediate annuity is a common type of immediate annuity. So this is where you purchase an annuity with one lump sum. So think of it this way. You're about to retire. Say you're 55 and you have $1 million, and you say, I want to buy a immediate annuity, and I'll pay $1 million today, and that will lock in a $3,000 a month income for me for life. So you could see how that could be attractive, because you can kind of trade in your money today and then get a guaranteed monthly income for the rest of your life, where you're sort of betting that you're going to outlive your money. So if you think that you're going to be retired for the next 30 years, and $1 million won't last you 30 years, then you could buy this annuity, and then you'd be pooled with other people in the annuity, and that basically would safeguard you ever running out of money. So that's sort of why someone buy a single premium annuity would be more closer to retirement. Now, the accumulation period prior to retirement, these are premiums that are collected with interest. So there are typically two types of interest rates: a guaranteed rate, which is the minimum interest rate that will be credited to the fixed annuity, and then there's also what we'd call the current rate. So the current rate would be based on the current market conditions, what the inflation is at, the bonds are at, and that could be guaranteed for a limited period of time. Now, when we're talking about a fixed annuity, it could be such as 2-3%, but a current is going to be based on whatever the market conditions are, and it could be tied to a treasury bill or LIBOR, and then that would give you, generally it might be tied to that for the first 5 years. It's not uncommon for annuities, to want to be tied to the current rate, because it's more sustainable for the insurance company. Say for example you retire at 70, and you want to receive $5,000 a month of retirement funds. So you might only have $3,000 set up between your retirement accounts and Social Security. So the other $2,000, you might want to figure out how much that would be, how much you'd need to have at the current rates to get that amount of monthly income for life. So these annuities could set that up for you. Now, let's move on to the next slide. Now we're going to talk about a few more annuities here as well. But before I go on to some of the other annuities, the reason we want to purchase annuity is because the real big reason is because it's not that this annuity is going to be that much of a windfall. You typically are going to be paying a lot of fees and a lot of costs when you join an annuity. So there are high fees and costs to annuity. So you're really not going to get the best return possible. But what you're going to get that no other financial instrument is really going to give you is that guaranteed income for life. Now, a bonus annuity pays a higher interest rate initially. So it might increase the amount of interest credited, to an investor. They might receive an additional amount of money or additional interest rate for the first year, sort of as an enticement. But this bonus is going to reduce the renewal interest accredited to the annuity in future. So it's not like you're getting something for free. It's just putting more of the interest up front rather than later. Now, if we look at the liquidation period, this is going to be when the funds are actually start to be paid out. So we talked about the immediate annuity, which starts the liquidation pretty quickly. But liquidation can be also thought of as the payout period or the annuitization period, and it's going to be so. First, the annuity. How the annuities work? It's sort of like a snowball. You start to accumulate you start an accumulation period where you're contributing to your annuity, hopefully when you're younger, because it's a lot less a monthly expense if you start these annuities when you're younger. And then there's a certain period where the annuity is going to start to pay out to the annuitant. So this is when once, and this is set in the contract, so you know how long the liquidation period is to accumulate to a position where they can start paying you a monthly lifetime income. So this is all stuff that's stated in the annuity. Now the periodic payments are going to be fixed in amount and they don't change, which is great. But you have to remember that these fixed annuities don't provide any protection against inflation. So what you think of is if you buy an annuity today, say you're 22, be very relatively cheaply to get an annuity where it's going to give you $3,000 a month income for life upon a certain retirement age. So your monthly payments into this annuity would be lower because you're so young. However, in 50 years, when you retire and you start being paid out of your annuity, $3,000 might be the equivalent of $500 today. So you can't live on $500 a month today, and in 50 years in the future, you probably can't live on $3,000 a month in the future. So that's one drawback of these. If you have a longer term frame annuity. So that's why if you're younger, you want to do an interest calculation or inflation calculation and say, okay, if I retired today, I would need $3,000 a month. Let's escalate that at a 2% rate for 50 years. How much is that going to be equivalent to when I retire? And then that's the annuity amount you want to set up today as you pay out for your annuity. So it might seem rather excessive today's terms, but when you actually get to retire, it will be right on spot, right on target. Okay. Now let's talk about deferred annuity. So this is going to provide periodic income payments at a future date. So that's basically what I was talking about as far as the deferment. Now, the immediate annuity, which we were talking about earlier, this is going to be an annuity where you put money in and then immediately you're going to start to be paid out. Now, the deferred annuity is a more common annuity where which I was kind of talking about before with the interest, is that you're not going to put a lump sum in today to get a payment out next month. You're looking to start putting payments into the deferred annuity at a much younger. And these annuities are generally a better deal because you're going to be participating in them for a much longer time. So the monthly payments are less, and you have a significant amount of more time to accumulate your balance in the annuity before it starts paying out periodic monthly income. So, although with a deferred annuity, it can be a single premium deferment, which is going to be purchased with a lump sum. So this would be something, maybe when you're 30, you purchase this, but the income is going to be deferred until you retire. So maybe you purchase this at 30, and then you're going to know 35 years later, at 65, you're going to start receiving income from this deferred annuity. Now, the benefit of doing this is that it's going to be a lot cheaper to buy that today than it will be when you're 65. So that's some future planning. Now, however, a lot of people don't prefer to do such a long deferment because typically if you had 30-year horizon to your retirement, you'd make a lot more money investing in stocks than you would in an annuity. Now, a flexible premium annuity is going to allow the owner to vary the premium payments. So what does this mean? So there's no requirement that a specific amount has to be deposited each year. So as far as the premium, when we say premium, usually refers to the amount of money you're putting in. So you have some flexibility of putting your money into the premiums you put into the annuity, which means when you have the money, you put it in. When you don't have the money, you don't put it in. So you have some flexibility there. But overall, if you underfund your annuity, your overall payments will be lower when you retire. Now, longevity annuity, this is a type of annuity that if it's really sort of just the worry of outliving your money, right? So this could be an annuity, sort of like sort of like an income insurance after the age of 85. So you could buy this. You say, I typically planned out that my retirement funds would last from age 55 to 85, and you have that. You're pretty confident of that. So if you're not sure you're going to live past 85, you may want to take the gamble of buying a longevity annuity, which is going to pay out at the age of 85. So the purpose is protect you against depletion of your financial income if you get older than you expected. So these longevity annuities, we'll talk more about later, are a pretty good thing, especially if, the current generation, if you're 22 today, the life expectancy is going to be over 100 by the time you get older. So there's a good chance that if you follow today's retirement structure, you're going to run out of money. And this is one of the problems of Social Security. So Social Security, when it was first enacted, at the retirement age of 62, 65, most people didn't live past 60. So it was a very solvent, very overfunded program because people just didn't live that long. A lot of people died in their 50s. And, a few did live, of course, a number of people lived past 60, but the life expectancy was much lower. Now, today with the life expectancy between 76 and 78, you can see that the life expectancy, at one point went from 50 years to 78 years. So that's a big jump. Social Security never fully anticipated that growth in longevity, and so different laws had to be enacted through the time to defer payments. People have to wait. Some people have to wait till they're 67, 68, 69 before they can collect their Social Security, and the amount that you get taxed is higher than when the plan originally started to compensate for these longer ages. So in the future, I'd anticipate that they're going to reset the retirement age of Social Security and rechange the tax structure of it as people normally ages start to live longer. Because within your lifetime, you'll see that cancer will be cured, that certain forms of heart disease and hypertension will be cured, and diabetes. Typical of the top 5 killers of people today, I think you'll see a lot of medical advancements to prevent or eliminate these diseases, which will cause people to live a lot longer. And which heightens the need for these longevity annuities. Now, a joint annuity is simply an annuity where the income payments are going to terminate when the death of the first covered person dies. So a joint annuity is based on two people. Think of mostly a husband and wife. So their payments are going to, stop when the first covered person dies. So this is a disadvantage as far as the income payment terminates when one of the partners dies. So the surviving person will still need income. So the joint annuity is really not a very popular one, although it is a lot less expensive because you're paying on the lives of two people. So the premiums are going to be lower, and the payouts may actually be higher. Now there are a joint and survivor annuity, which sort of helps to fix this problem, where it's going to pay based on 2 lives, and it's going to continue to pay even when one of the 2 people dies. So that's the sort of a fix to that. But this is really not that common of annuity anymore. Now, depending on how the annuity is structured, think of the annuity like a contract. So you're buying this through an insurance company, so it's a fairly complex contract with a number of flexibilities built in. One of them could be your payout options. So under the cash or guaranteed installment option, funds can be withdrawn in a lump sum or installments. So, some people may choose just to completely make a lump sum payment out of the annuity, or rather choose monthly installments. Now, if you wanted to use the annuity as a source of income, you'd probably want to have the monthly installments as a payout option. Now, a life annuity with no refund, this is going to provide a lifetime of income, but only when the annuitant is alive. once they die, whatever remaining funds are in the annuity, the insurance company would get that money. So this makes it, the reason it sounds like, well, that's not a good deal, but the premiums to pay into the annuity are much lower when there's a no refund option, because the insurance company is taking a gamble that the people who die sooner will help cover the cost of the people who live longer. So having no refund is a way of lowering the cost of the annuity while covering your income. This might be good for people who don't have children or who have other sources of assets they could give in life in their will, where they don't really need to rely on the annuity equity to be inherited by their children. So it might be a good idea for couples with no kids. Now, a life annuity with a period that can pay a certain income to the annuitant and a certain number of guaranteed payments. So there, because these are contracts, all sorts of different things can be created. So if you want to have a life annuity with guaranteed payments, it's going to pay a life income with a certain number of guaranteed payments. So what exactly does that mean? What this basically means with the life annuity, the guaranteed payments, they make guarantee payments for 15, 20 years, and then if the annuitant dies before receiving all the guaranteed payments, the remaining payments will be paid as beneficiaries. So this is a way of saying, it's sort of a hybrid where we'll set a time frame of 15 years where there's guaranteed payments, and if I die, those payments go to my wife, but only up to 15 years. That doesn't mean if you live beyond the guaranteed payments, you're still going to be collecting payments as long as you're alive. But if you live beyond the guaranteed payment time frame, your dependents won't receive anything once you exceed the guaranteed payment time frame. So again, basically the way it works is that the annuity guarantees that I'm going to receive payments for 10 years. If I die after the first year of payments, the remaining 9 years of payments go to whoever dependents I want to place them to, which usually would be a wife or your children. So this way, you don't have a situation where you pay $1 million into an annuity and then you die the next day and the insurance company gets everything. So this is a way of sort of taking some of the sting of that no refund annuity. Okay, let's move on to the next page here. Next slide. Okay, and let's talk about installment refund options. So now, the installment refund options is going to pay a life income to the people who buy this annuity. So if the person dies before receiving the total payment equal to the number of purchases of the annuity, the payments continue to the beneficiary until equal to the purchase price. So basically saying that if I put X amount of dollars into an annuity and I die before I've consumed those dollars, my beneficiary could benefit, and the remaining money equal to the purchase price will be paid out to the beneficiary. So another version of this could be the cash refund option. So this is going to be, it's very similar, but it pays the beneficiary a lump sum. So instead of trying to figure out, okay, you had $50,000 left in payments that weren't paid out to you, and that's what the beneficiary gets, it's just going to simply state, if you die before receiving total payments of the purchase, the balance, a balance paid in a lump sum is going to be paid to the beneficiary. So that would be, a lump sum rather than, monthly installments. So in this, cash refund option, basically whatever is left gets paid out as a lump sum. So if there was $123,000 left in payments yet to be paid out, you get the lump sum rather than installment refund. Now, we have to keep in mind that cost of living adjustments is based on the fact that there's inflation. So these cost of living adjustments are a good feature in an annuity because it's going to increase the benefits to help protect against inflation. So if an insurer offers a cost of living adjustment, it's generally a good idea to take it because we really have no idea what inflation will be in the future. Inflation for the last 20 years or 30 years have been pretty tame, but in the future, inflation could be much more vicious. So it's generally worth it to pay the extra money to get the cost of living adjustment. Now, some insurers can make available a rider, which a rider is a sort of an additional stipulation in the contract to allow people to make a partial cash withdrawal. So the fear here is that if you are locking your money up, putting your money in annuity for a long period of time, you have no access to that money in case an emergency arises. So there can be, some sort of rider that says, there are some circumstances where you can take out a lump sum of money that can be requested and paid back at a later date. So they kind of built in some flexibility in a partial cash withdrawal. So that way you don't feel like your funds, in case something happens, you want to make sure there's an ability to get that money if you need it. Okay, so here is the chart of monthly annuity payments from an immediate annuity. So if you put $25,000 paid down today, this would be your income chart. So you have life income only. That would get you about $1,500 a month, or $1,478 a month. Life in 5 years certain, and this is what we're saying that the amount of the certain is the where you sort of protect the balance to your dependents. So the higher this number is, the less the payout's going to be. So we could have life with a cash refund, and then we could have the period certains on this cash refund. And the longer the period, the less the monthly income is going to be, because the more likelihood that a balance is going to be paid out to dependents. So this is all factored in, and changes. Like these monthly incomes change every month. So this is just a point in time. So it depends on, every line you see here is a different type of annuity you could get as far as options. So that's why when you do the annuities and you work with your insurance agent, or if you are the insurance agent, you have to really work with your client closely to get a better idea of exactly what their needs are, what their expectations are, and come to an agreement on the type of annuity with the certain options and riders that they feel comfortable with, so that they can have some peace of mind that their retirement's covered, but also their dependents will receive some money in case they die early. All of this changes the schedule as different things come and go. Now let's switch over to variable annuity. So this is going to be, a lifetime of income, but the income payments are going to depend on common stock prices. So this is a little bit different here. So the payments, I guess, are going to vary as far as the investment options of the account, where the premiums are invested. Now, so if we invest in common stock, it's going to be a riskier annuity with the potential for higher amounts of accumulation. So the purpose of this annuity is to provide a hedge against inflation, because stocks are a big hedge against inflations. So we want to maintain the purchasing power for this person's retirement, and stocks over the past 200 years have beat inflation. 20-year time frames have always beat inflation, and 90% of 10-year time horizons, they beat inflation. So the variable annuity can have this correlation with stocks and provide a better outcome for participants. But there's going to be a little bit more risk, to get this hedge against inflation. So you're going to use your premiums to buy what's called accumulation units. during the period prior to your retirement. So it's sort of like paying into a mutual fund. And then at retirement, the accumulated units are going to be converted into annuity units, and that's what's going to pay you as far as the cash. Now, because it's tied to common stock, the payments are going to be higher because of the higher returns, where some other annuities might be invested in more safe options that are going to better protect principal. These are going to be a little bit more riskier, take some more risks to help increase the value of the funds over time and therefore eclipse inflation. Now, so when we talk about these accumulation units, we're really talking about buying shares. It's almost like buying shares of a mutual fund every month until you retire. So these accumulation units is how we're storing up the value, and that money goes to buy stocks that are going to be done through a fund manager. So this accumulation phase, it has to be a certain amount of time. The longer the accumulation phase, the more money you'll have in the retirement. So it depends, the price of the accumulation unit is going to vary on where the common stock prices are, just like in a mutual fund. So hopefully, if you have a long enough, I would recommend for long retirement time horizons, 20 years or more. These would probably be the best things to be, the best return on your money. Now, when you actually do retirement, I was talking about these annuity units. These are going to be basically, it's going to determine, you're selling, think of it like you're selling your accumulation unit, and that becomes your annuity unit. And it's going to be based on whatever the large part of value is in your annuity fund. So it's basically like selling your shares in a mutual fund. So the number of, but at the time, the number of annuity units is going to initially be tied to the assumption of what your mortality rate is. So it's a complicated calculation, trying to figure out how long you're going to live, the dividend rates, the expenses, and the market value of the stocks that are inside the annuity units. And then once that's determined, the total number of annuity units remain constant during your liquidation period. So say you get 5,000 annuity units. So then each unit is going to change each month depending on the level of common stock prices in the other investments. So this is the number of annuity units multiplied by the current value of each unit to determine the monthly amount paid. So this is similar to, it's basically the insurance company taking your money, putting it in the mutual fund, and then when you retire, paying that money back out to you. And depending on how they want to structure it, some of these variable annuities, when it says variable, because you're not sure what monthly income you're going to get. Now, some of these funds can just, day one, convert all of your stocks into a cash pool and pay more of a fixed annuity after that point. But most of them, what they do is they'll convert your accumulation units to annuity units and then pay them out, which means they could still be subject to the changes of stock prices if it's not converted into more of a secure asset. It all depends on how the insurance company wants to structure the product. So, and then on that point, it depends on how you feel comfortable with the different risks or the different aspects of it. Now, as far as, guaranteed death benefit, so in many cases, annuities may leave your dependents with no money. So you might want to have this guaranteed death benefit. So with a variable annuity, it's more typical than not, it's going to provide some sort of guaranteed death benefit, especially during the accumulation period. That's going to protect the principal against loss due to a market crash. So if you die during the accumulation period, the amount paid to your beneficiaries will be the higher of the two amounts. Either one, the accumulation value of the annuity, or the amount of total premiums paid adjusted for any withdrawals. So if you do die, if you buy this annuity and you do die during during a market decline, say a market crash, the beneficiary is going to receive at least the amount equal to the premiums that you paid into the fund without any withdrawals. So that would sort of protect you if you're worried about market crashes. But if there isn't a market crash, some of these annuity funds will go one step further and provide enhanced death benefits by the payment of additional premium. So they can guarantee the principal that was paid into it plus interest, or the periodic adjustment of value for the amount locked in the investment gains. As an example, let's look at a death benefit can be reset. So that's a 5% rising floor benefit can periodically be reset so that the beneficiary will receive 5% of the principal plus 5% interest. The second example could be a stepped up benefit where the contract periodically locks in investment gains every 5 years. So say example that you had $20,000 invested, then the account grew to $40,000 in 5 years. The new death benefit would be the $40,000, even though the owner has only invested $20,000 in it. So these enhanced, these are all enhancements that make the annuities more attractive, but anything that's going to benefit you inside of annuity as a customer is going to cost you as well. That's why it's important as an insurance agent to really size up what your client needs are, get as much background of their story, their life, their family, to try to give a product that's going to best suit them. So some variable annuities, do that enhanced death benefit that I just talked about to help alleviate some fears people may have of the insurance company getting all their money. So they want to make sure that with these lock-ins that there's going to be fair to the beneficiaries of their family. Okay. So let's talk about the fees and expenses. So annuities, as you may understand, are not as common because many people feel that they have excessive fees and expenses. Now, that's why the pooling effect of the annuity to help guarantee your income if you live a long life is the one thing you can't get from your normal retirement funds. So your normal retirement funds are just what the money you have, and that could run out. So the real benefit that makes annuities attractive for most people is the fact that you have a guaranteed lifetime of income. And in order for the insurance companies to do that, they have to structure the product in a way that they're going to profit off of a majority of the participants. And it's the same thing with Social Security. Social Security was originally designed that, 60% of the participants would not collect the money. The other 40% who do collect the money might get more money than they paid into it. This percentiles have changed as life expectancies have changed. So we're going to talk about the fees and expenses of annuities. It depends because these are contracts. Each insurance company could write in different structure of fees and expenses. Now, the investment management charge, this is a charge that's going to pay for the annuity to hire an investment manager or investment managers who are going to, work to organize the investments of the annuity. So the investment advice, the portfolio creation, the management of all that, that's going to be a charge for those people who need to be hired to manage the annuity. Now, the administration charge, this is going to cover people in the insurance business who are going to be the record keepers, who are going to be the administration, who are going to produce and mail out the reports and the to the participants. So there's a certain amount of administration charge just for running the business. And part of that administration charge could be, an advertising and marketing charge built in there as well. Now, the mortality and expense risk charge. Now, this fee, often called the M&E fee, this is going to pay for any mortality risk associated with a guaranteed death benefit or excessive longevity. So it's an additional fee to help cover those who are going to live a long time that, may not be covered by the people who die early. So these annual expenses, hopefully will not exceed a certain percentage of the assets of the contract that is issued. That's something that is regulated. So you don't want to have an annuity that's going to, gobble up all your money in these expenses and charges. So that's why if you're before, it's always important with a client to go over the fees and expenses. And if you're working for a company that has a lower fee structure, it might be beneficial to compare them to other companies' annuity products to show, like, see, we charge less, you get more money, it's a better deal from us. That's always an easier sell for people a lot of people today are focused on these expenses and fees. Another one could be a surrender charge. So this is with a variable annuity, you could have a surrender charge, which helps pay agents and brokers who sell variable annuities, and is usually a percentage of the account value, and declines over time if the annuity is surrendered during the early years of the contract. So this is basically, if you want to get out of the annuity, there's going to be sort of an exit fee. So the surrendering is sort of giving up the annuity, and there could be a percentage charge on the total value of the annuity that declines the longer you have the annuity. So after a certain point, the surrender charge will disappear. Now, because that these annuities can guarantee income for a lifetime, the fees and expenses of most variable annuities are going to be high to compensate for the fact that the insurance companies could lose money if too many people live for too long. So this structure is continually reviewed and updated to make sure that the insurance company is staying one step ahead of the longevity rates of their participants. Okay, so let's move into the fixed income annuity. Now, this is a lot of annuities that we're talking about here. Each insurance company, you may work for one specific insurance company or be a broker for many insurance companies, but each insurance company is going to have their own structure and their own portfolio of annuities that they offer. So these are just a really broad categorization of annuities that are common annuities most insurance companies will offer. Your job, when you do get your job, you'll have specialized training on the unique products of the companies you're representing, and they certainly will be different than the basics that we're talking about in the textbook. So this is where a lot of research and studying comes in once you get your job, to really know your company's products, to sell them better. The better you know your company's products, the more confidence your customers will have when they ask you questions. You won't have to look things up. You'll know right away. This sometimes comes with experience or a lifetime. So let's move into the fixed indexed annuity. So it's this is offers a guaranteed fixed annuity and limited participation in the stock market. So again, another hybrid type of product. So it provides downside protection against the loss of principal and prior interest earnings. So what does that mean to you, or to a customer? Well, customers want protection, and they fear certain things, especially a stock market crash or anything that could affect. So if premiums are paid to purchase a fixed index annuity, are not directly invested in stocks or in bonds like a variable annuity are. Instead, the annuity value is linked to the performance of a benchmark, say the S&P 500 or the composite stock index. So we link it to a performance of an index. Means that if the index goes up, we're going to participate in that growth. If the index goes down, we're going to get a certain guaranteed rate of return. So this is better than investing. Say you were to invest just in an index mutual fund. It goes up 20%. next year goes down 20%, you're going to lose, 20% that next year. But with this annuity, it's going to prevent any losses, and you're only going to participate in the gains. Sounds too good to be true, right? And this is all possible through the magic of future contracts. Now, but how the insurance company is able to do this is basically they're not going to give you any dividends because they're not going to really own the stock. They're going to buy some sort of option contract or futures contract that is going to help protect the insurance company from any downsides. So that way they're able to, when the downsides do occur, the insurance companies aren't going to be losing that money because the financial instruments they're buying are going to protect them from that loss. Now, unfortunately, what that means is that when the stock market does go up 20%, you're not getting that full 20%. They're going to keep a certain percentage of that to cover the commission and the costs of setting up these financial products to help design this product. Now, so this is, I guess, could be a little confusing. So the fixed index, you got to remember a couple elements. There's a participation rate, a maximum cap rate, and an indexed method used, as far as and also getting a guaranteed minimum value. So what we mean about this is that let's talk about the participation rate first. So the participation rate is going to be a percentage of increase in the stock market index is going to be credited to the contract. So this could range from, this depends on each contract. It can be anywhere from 20 to 80% of the gain of the stock market. So you want the contracts that pay a higher percentage of the gain of the stock market. So basically, if you have an 80% contract, if the stock market goes up 10%, you get 8% of that gain. If you only have a 25% contract, if the stock market goes up 80%, you only get 25% of that gain. So this is going to be all reflected in the price of the annuity. The better the participation rate, the higher the participation rate, the more expensive it is going to be to get that contract, the annuity contract. Now, talk about the maximum cap rate. So this is something that many annuities are going to have a maximum cap rate, which you have to pay close attention to explaining this to your clients, because this is going to limit the amount of interest rate credited to your annuity. And so basically, if you had a cap rate of 5% and the stock market returns 20%, the interest credited to your annuity would only be 5% and not that 20%. So this puts a limit on the maximal capitalization rate you can get as a return. So you want this max cap rate to be as high as possible, because typically the S&P 500 could average a 10% return over 20 years. So if your cap rate's only at 5% and that 20 years have been pretty good and the average rate's 10%, you're missing out on a lot. So the higher the cap rate, of course, the more expensive the annuity. Now, as far as indexing methods, this is going to refer to the crediting of the interests from the stocks to the annuity. So there can be different ways of indexing methods to credit the interest. So basically, we call it interest. So when the stock market, the S&P 500 has a gain, when they're going to pay that gain into your account, we're going to call that interest. So under the annuity point-to-point method, the interest earnings are calculated based on the annual change in the stock index. So we look at not monthly, but an annual, from whether it's going to be December 31st. So the contract is specify the end date of the annuity, of the annualization of the capitalization of the stock market. So, and this is going to be reset annually. So if the stock market is going to decrease over a particular contract, that decrease may have to be recovered before any additional growth in the index will be credited to the contract. So this indexing method, we can kind of something you got to worry about as far as explaining this to the customers. Now, a guaranteed minimum value is going to be an important selling feature for this contract. So accumulation value that's going to apply to each year regardless of the performance of the stock market. So, for example, the annuity may guarantee 105% of the initial premium if the benchmark declines over the life of the contract. So this basically, you're going to get the initial premium plus 5% guaranteed in credits. So this is something that there's going to be a minimum. You're never going to lose money, basically, is the selling point of this contract. You'll never lose money. If the stock markets go down, you're going to have this guaranteed minimum. Even if, God forbid, there's 20 years of stock market declines, you're not going to have to participate in that. And that's something that is of great reassurance to clients, sort of protecting them from the downs of the stock market. But you have to give up some of the upside to get that. Now, let's just talk about some limitations of the fixed income annuities. They are the more complex annuities. So it's more difficult to explain them to clients. So a more sophisticated client would be required to really fully explain how these fixed indexed annuities work. A real drawback for the investors in this is that dividends are not reinvested. And that's a key part of the returns, let's say the S&P 500. And if, because the returns don't match the stock market 100%, typically much lower, it can be anywhere from, usually 20 to 80%, depending on the contract. The investor is only going to receive part of the increase of the stock index. They're not going to participate in the full increase of the S&P 500 or the dividends. So it's going to be sort of, you're giving that part up so that way the benefit of that is that you're not going to have to absorb the losses. There's going to be a guaranteed minimum. So even though you don't get the full return that you would in the S&P 500, you don't get any of the punishment of it either. And this is critical to investors. So investors who are going to retire, they don't want the risks of a 5-year bear market. They want some kind of guaranteed retirement monies that they can count on. And that's really what this product is trying to generate. Some of the benefit of the stock market, but none of the drawbacks of the stock market. Okay, let's talk about longevity annuities. So these provide, again, we've mentioned these before, but the risk against depleting your financial money before you die. So that's a horrifying concept, right? You're 95 and you have no money. And no, you can't work anymore, and maybe there's no one out there to help you. What's going to happen to you? Very scary. So these longevity annuities play on that fear, and they're a way of providing a lower cost structure because there's no cash value, no death benefits to these policies, and they typically start at a more advanced age. So, and there could be some features where it could provide death benefits, inflation protection, starting the payments earlier before 85. So these longevity annuities, of course, like any contract, can be modified. Since these are not standardized, tradable investment vehicles like stocks and bonds or mutual funds, they're contracts written by insurance companies. So anything can be included or taken away. Typically, this is why insurance agents sell these products, because they're too complex for the average person just to decipher themselves. And most people would not buy them unless they had an insurance agent to really explain to them how it works and what advantages it would be, because some of these products will fit in quite nicely to certain people's circumstances, which would really be the best thing for them. You could see how if you're 85, a longevity annuity would be a better bet than putting all your money in the stock market. Okay, so here are some benefits of advantages for the longevity annuity. One, the benefits of this are going to kick in usually 85, usually around the point where most people's assets are declining significantly. They're a lot less expensive because there's the chance that you won't live past 85. So the insurance companies start taking a gamble on you. And if they take enough people in a pool, then they can charge much less because they're figuring probably half the people won't be able to collect, so they can make the premiums for everybody a lot less. So there's a pooling effect of it. And you can, of course, like any of these annuities, they can be tied to an inflation hedge. So if you buy this when you're younger, you're going to be worried about inflation if you're going to be living 15 years into the, or if it's 15 years before you're going to receive it, then that the money, the annuity, may be significantly less purchasing power. Some disadvantages is that because, which we discussed here, about that your beneficiaries are not going to inherit the money. So one of the reasons also that makes it cheaper is that if you die early, whatever you paid into the longevity annuity gets to be kept by the insurance company as profit. So that helps keep the rates down. But that's a disadvantage to you if you don't want all your money to go to the insurance company. But also, once this is purchased, your funds are locked up. You can't get that money back. You can't sell it. Most contracts, I mean, insurance companies could make specifications, but generally, most of the time, once you get this, you're stuck with it. And there's a good chance you're not going to receive the amount of money that equals the purchase of the product. And that's what the insurance company is betting on, and that's how they're going to make a profit. But for a lot of participants, they may not care about that. They just might be worried, like, listen, I'm willing to put $200,000 into this, and if I die a day after 85, fine. At least I never have to worry about living to a certain age with no money. So it's a good aspect that way. Okay, so let's move into what we call qualified longevity annuity contracts. They're QLACs for short. Now, so say that, how can I explain this? This is going to be another type of annuity for sure. But say you're an employee in an employee-sponsored qualified retirement plan. That would be like a 401k. And with a 401k, you could exhaust the amount of money in that plan while you're still alive. And that's really the fear. So this qualified longevity annuity contract is going to be designed to deal with that risk specifically. So it is deferred annuity contract with a lump sum premium is going to be paid today to provide a lifetime of income at some future date, typically anywhere between 1 and 50 years in the future, or here 2 and 40 years in the future. So this is going to help bridge that gap where your 401k may not meet. So for example, you could have a 401k with $1 million worth of assets in it. It's going to provide you, say, $6,000 a month of income, but that is going to be a combination of returns and principal. So at some point, that's going to be exhausted. And it's going to be worth less with inflation. So if you're going to deplete that and you want to maintain your monthly income, then this QLAC can continue for the remainder of your lifetime. So it's sort of like an insurance and annuity product together. So you'll be able to maintain your lifestyle and extend the length of your retirement. So let's go over the facts again. The income paid is specified in advance and depends on your age, your gender, and the size of premium that you're going to expect. Now, this is going to be purchased before tax savings. In a qualified retirement plan such as an IRA or 401k. Now, what does that mean to you? So I guess I could explain it as the tax-deferred element of it is an important aspect that we're going to discuss later, but it helps deferring those taxes. The idea is that you pay more taxes when you're working than when you're retired. So that will help, assuming the tax law doesn't change. So if you're buying this before tax savings, that's going to have a significant impact on making your money go further. Now, and the QLAC is also exempt from required minimum distribution, what they call RMD rules. So it's exempt from these required minimum distribution rules, which with the 401k and the IRA, you're going to have to make withdrawals at 70 and a half. That's just, you have to make withdrawals at that age because the government wants to start making back some of that deferred tax. Now, when you purchase a QLAC from a tax deferred account, it's going to reduce the balance subject to these RMDs. So that means that this can be deferred for a later amount without having to be withdrawn, which is a good thing. So again, these QLACs are sort of a rarity, and they're not that common because they typically have to be paid for with money, say in your IRA, would be used to buy it. And it's a way of restructuring your IRA to make it of a longer term usefulness. Okay. Let's talk about MYGA, multiple year guaranteed annuity. So this is another deferred annuity that's going to allow you to invest a lump sum for a specific amount of time for a fixed rate of interest, typically 3 to 5 years. Now, let me give you an example of that. So say you want to invest $200,000 in a 15-year MYGA that's going to guarantee a 4% interest rate. At the end of the contract, you have the option to annualize the account balance, withdraw part of all of the funds, or leave the funds invested at a renewable rate of interest, or roll the funds over to a new MGYA. So let's talk about some of the characteristics. And again, this is deferred income annuity that's going to allow you to invest a lump sum today for a specific period to give a specific amount of return. Again, these are not that common, and not all insurance companies will offer them, but most investors are going to follow the withdrawal of the interest as it is earned without paying a surrendering penalty. So that's sort of a benefit. So you will be allowed to withdraw annual withdrawals up to 10% of the balance without any penalty in the annuity. So if you withdraw more than 10% of your annuity balance, you could be charged those surrendering fees. So that 10% of your money is the most you can get without really paying any of those fees, which can be a percentage of the amount that exceeds the penalty-free amount. So there is what they call a market value adjustment, and this may increase or decrease the penalties for excessive withdrawals or early surrender of the annuity based on the formula that's going to compare the base interest rate of the contract when the policy is first issued with the base interest rate of a similar policy at the time of withdrawal or surrender of the policy. So it's basically trying to make it a little bit more fair, so the MVA will have a positive impact on how that offset part of the surrendering charges. So it's just trying to build a little bit more fairness into the annuity. All right. So let's look at the non-qualified annuity. So individual annuity purchased from a commercial insurer is a non-qualified annuity. So what that means is it does not meet the IRS code requirements. It does not qualify for most income tax benefits. Premiums are not income tax deductible. Interest income is tax deferred. The net cost of the annuity payments is recovered income tax free over a payment period, but the amount that exceeds the net cost is taxable as ordinary income. So they have these, what doesn't qualify for these tax benefits. And that's why we call it non-qualified, which means that you're not going to be able, it's not going to be like an IRA or 401k or some of those other vehicles I talked about earlier, where you're going to be able to defer your taxes on them, which could be important depending on who you are and what point in time you are making these investments, whether tax deferment is important to you. But the IRS are going to, they're going to have requirements for certain employer benefits. So this is why insurance companies like to make products that are going to be included in qualified annuities, but to get these retirement benefits, because it makes the accumulation so much greater for the annuity. And that's the basic idea there. But sometimes investors reach their limits of what they can qualify for tax deferred, but they still want additional annuity coverages, and that's where this non-qualified annuity will step in once you exceed the limits of your tax deferments. You can now move into these non-qualifiable annuities. So this exclusion ratio can be used to determine the taxable and non-taxable portions of the payment. So if you're putting money in that's been taxed, and then you're not going to pay tax on the investment gain, sort of like a Roth IRA, you want to have this exclusive ratio to know what you're going to pay tax on, what you're not going to pay tax on. So this can be attractive to investors who made maximum contributions to other tax advantage plans. Basically, if you put all the money you can in tax deferred accounts, and then you start putting money into annuities that's not tax deferred, or additional money that's going to be taxed first and then invested, you're going to be able to withdraw those later without paying tax on them. So that's why I need to know the difference of the ratio between the two funds. So here's an example of, let's say this is Ben at age 65. He's going to, an immediate annuity, $108,000. He's for a monthly income of $1,000. So the IRS is going to say a life expectancy of 20 years. So we do 20 years times 12 times 1,000. So his payout's $240,000. So now if he paid $108,000 in, and this is money he already paid taxes on, his exclusion rate is going to be 45%. So each year he's going to receive, if you take the total 12,000 multiplied by 45, he's going to receive 5,400 tax-free and 6,600 taxable. And that's going to be equal to the $12,000 he's going to get per year. So part of it will be tax-free, part of it will be taxable, because a chunk of the money went in that he paid taxes on. The rest of the money he's going to be receiving tax-free. So when it comes out, when it gets paid later, is going to be a breakup between what he pays taxes on and what he doesn't pay tax on. Okay. So now, look for part 2 of this lecture, where I'm going to move into IRAs and talk about traditional and Roth IRAs. That will be part 2 of this lecture for chapter 14. Thank you for your time today, and I look forward to talking to you soon.